Hello and welcome to How We Manage Money. Today I'm going to walk you through our adaptive institutional fiduciary processes to how we manage money. My name is Joe Maas. I'm your Chief Investment Officer, and I'm glad to be here with you today. We are going to go over a brief introduction. We're going to talk about the problems that we see in investing and how to handle some of those. We're going to go over some principles of investing, and then we're going to review how we build our portfolios. So, everything begins with a process. We believe that success is hinged on duplicatable, repeatable processes. And so our investment planning process starts off where we want to understand your goals. We want to create a plan, craft your portfolio, and then keep you on course. Okay, so that's a general overview of what we're trying to accomplish. And in doing that, what does the perfect investment look like, right? So have you ever thought about that? What does the perfect investment look like to you? Well, for a lot of people, that means there'd be 100% liquidity. They'd always have access to their money. For others, it would mean that there's no loss. They could never lose their gains, right? That'd be nice. And of course, double-digit returns. That would be a wonderful thing to have in your perfect investment. Well, I have news for you. It doesn't exist, right? That's the pink unicorn. So we know that that's impossible, that you can't have all of those things in any one investment. In fact, you really have to understand what you're willing to give up, and you can probably only have two out of those three. So, for example, you can have liquidity with some protection. Those are vehicles like your checking account, savings account, money market, CDs. The rates of return are lower, right? But you get a lot of safety and protection. Or you could have protection with some gains, and those are your structured products, your index-linked accounts. They're going to range to 4 to 7%, okay? Or you can have gains with some liquidity. And of course, that's like what we like to call red money or stock market investing in stocks, bonds, mutual funds, ETFs, and real estate. And again, you might be able to get 30% returns. The market's had a great year in 2019, but there's other years like 2008 where the markets are down 40%. And so the red money, you have to be able to go up and down. So you have liquidity with some protection. You have some protection with some gains, and you have gains with liquidity. And so really the secret of what we're trying to do is find the right balance for you in deploying these. So we can build you a diversified portfolio and try to get you as many of these attributes as possible. So how do we do it? Well, we're an institutional fiduciary management firm. And what that means is that we're different than your average retail investor or experience that a lot of people have been used to. So we have all the big names available to trade with: Goldman Sachs, Morgan Stanley, Bloomberg, Zacks, J.P. Morgan. We get their institutional research, and we're able to trade with these people, but without the bias. So we don't get the stock list in the morning of what we're supposed to sell, right? Because we're fiduciaries, we're not brokers, and we don't have to rely on them to be told what to do, but we can trade with them and we can access their research. So we kind of get the best of both worlds. And some examples of that for you, what's the benefit to you on how we manage is that, let's talk about bonds for a second. And I will use a beer example of all things to help us understand this. So if you want to buy a bottle of beer, you can go to 7-Eleven and you can buy a bottle of beer, and maybe you'll pay $5 for that bottle of beer. But if you go to Safeway, you can buy a 6-pack of beer, and maybe now you're only paying $4 per bottle, but you had to buy 6 bottles. And of course, we can go to one of our favorite local stores here in Seattle, Costco. And if we go to Costco, we can get your bottle of beer down to $2, but we have to buy a case of beer, right? So it's like buying beer at 7-Eleven, Safeway, and Costco. Well, in the investment world, with bonds, we can buy bonds, again, at retail pricing, at retail levels. That's equivalent to the Safeway or 7-Eleven example. We can buy bonds at a little more an institutional process and get Safeway pricing. Or of course, we're able to go out and trade with all these institutional partners and others, look for the best pricing, and really bring that Costco pricing into our bonds when we purchase them. And we can do the same thing with equities and structured notes. When we build a structured note, we custom build it. We don't use an intermediary to do that. So we go direct to the source, right? We'll go back to New York. We'll talk to Goldman Sachs. We will build and engineer what we want, and then they'll help us price it and deliver it to you in your account. So again, we're able to trade and operate at an institutional level, and it just gives you better pricing and a little bit of an edge when it comes to managing your money. So it's something we're very proud of. We're proud of having those big names and big research, but without the bias. And we're very happy to be able to bring you a better institutional experience than you might have had with the retail experience, and get you better pricing and just do a better job for you overall. So what are we trying to do with this institutional money management process? Well, what we're trying to do is build better portfolios for you, right? We're trying to ride the bulls and tame the bears. We're trying to build reasonable portfolios over reasonable time periods with reasonable risk, right? And it doesn't matter if you're in the accumulation phase, the distribution phase, or the preservation phase, we will be able to overlay our processes on top of that for you. So if you are younger and you're starting off trying to accumulate wealth, we'll have portfolios for you. For the majority of you who are near or in a work optional lifestyle, it's what we call retirement, a work optional lifestyle. You're probably looking at how do I get some income? I've grown my money, now I want to have some distributions. And as you go through your work optional lifestyle, you then turn to, well, I've spent what I'm going to spend, and I'm thinking about my legacy planning and the distribution to my heirs or charities. And so now you're working about preservation. And so regardless if you're looking for accumulation, distribution, or preservation of your wealth, we will be able to help you ride those bulls by capturing that upside return, minimizing the downside capture, while building better diversified portfolios with reasonable risk-adjusted returns over reasonable time periods for reasonable people. So this is just a fun chart. Most people think they're going to go from A to B in a straight line. We know that doesn't happen. The markets go up and down and sideways. And so we're going to help you get from point A to point B. We're going to help you navigate and negotiate the pitfalls of economics and geopolitical concerns, but it's not going to be a straight line. Okay, so we will help you get there, but you can expect the path of reality and not the path that most people believe is going to happen. Okay, let's talk about a quick overview. Here what we want to touch on are the behavioral biases that creep into portfolio management, and then of course negative compounding, which we'll explain in just a few slides. So what's the problem? Well, most people underperform. And why do you underperform? It's because we get in our own way as investors, right? We have emotions. We have behavioral biases. And the research has shown that puts us at a disadvantage. A prospect theory will say that people are willing to take more risk not to lose money than they're willing to take risk to make money. And that's not a good proposition. And so most investors have become what's called loss averse as opposed to risk averse. Somebody that's risk averse is looking for a reasonable risk-adjusted return. Somebody that's loss averse remembers 2008 or fourth quarter of 2018, and they're willing to take more risk to avoid that pain of going down than they're willing to chase those returns. And so because of that, most people do not have patience, they're not disciplined, they don't have rules, and they don't have institutional processes. So in our institutional process, we're going to eliminate a lot of these biases. And if we eliminate a lot of these biases, then we're going to help you perform better, regardless if you're trying to accumulate your money, spend it, or preserve it. This is just a fun chart from a Bernstein research project that they did. And it shows that, that over the last 20 years or so, the S&P 500 has done 9%, and investors do too. So again, we're just trying to close that gap and get you a little bit more of that return by introducing some institutional processes and procedures. So here's a fun chart of the S&P 500. And we know since from 1953 to the end of last year, that the market's been on a great bull market. And so if you'd bought at the bottom of this chart and held on, the old buy and hold, hope and pray strategy, you would have done really well. But what about in the interim, right? What about the short periods in the market? Well, during the short periods of the market, we know there's a lot of drawdowns. And so the blue lines on this chart represent the 5% drawdown over a 30-day period. The yellow bars represent a 10% drawdown. And the red bars represent a 20% drawdown. Now, what we're trying to do is, if you want to make money, you have to be accepting of the blue and yellow bars, and our job is really to avoid the red bars or larger drawdowns. So some of you might say, well, isn't the job to to avoid all drawdowns? And that's just not possible. And as you're going to continue to learn today, if we do that, we're going to avoid return. Remember, risk and return go together. And so if we're so focused on avoiding drawdown and avoiding risk, what are we also doing? We're also avoiding that return, okay? So there's going to be some drawdown periods. We're going to be accepting of the blue and some of the yellows, and we're really trying to lop off the reds. And so let me explain why those blue and yellow bars are not as alarming to me as the red bars. So we have what we call negative compounding. Negative compounding says that if you start with $100,000 and you go down 10%, that you need 11.5% to break even. Now, most people, when asked, well, if your portfolio went down 10% and the next year it went up 10%, you're back to even. And they say, yeah, I was down 10, I'm up 10, I must be back. But remember, what goes down must go up farther than what it goes down in order to break even. So here, you'd have to earn 11.1% to break even, to recover your $100,000. So this chart shows the different break-even scenarios. So you'll see here that in 2008, when the market was down about 40% of the time, right, bring my mouse over here, right about here, that it would have taken you 66% to break even, almost 67% to break even. And if the market could do a 7% rate of return, it would take you 7.5 years to break even, okay? That's a long time if you're in or approaching a work optional lifestyle. But look at the 5% drawdown. A 5% drawdown only requires a 5.26% recovery rate, and at a market rate of 7%, we can do that in less than a year, 0.76%. A 10% drawdown, you only need to go up 11.1% to break even, and again, at 1.5 years at 7%, you're going to break even in a reasonable period, a recoverable period, and so we need to be accepting of those 5 and 10% drawdowns if you're expecting to make any money. Again, our job is to really try to lop off the larger drawdowns and prevent a period that's unrecoverable. So that's how we look at the drawdowns, and we are suggesting that people take a little bit more risk than they have in the past if they're wanting to accumulate more wealth. So the last slide that we'll use here to illustrate this concept is, here's two portfolios. One is a stable portfolio, one is a volatile portfolio. The portfolio that's stable is 10, 10, 10, 10, 10, so after 5 years it averages 10%. The volatile portfolio is up 20, down 40, up 50, down 30, up 50. And it also has an arithmetic average of 10%. But when we look at the growth of a dollar, we'll see that the first portfolio that was the little engine that could, the 10% per year portfolio, ended up with $161,000, and the portfolio that was volatile, even though it also averaged 10%, had $113,000, okay? So again, what we're trying to do is, we believe you can make more money by not losing money, by avoiding those drawdowns, while at the same time being accepting of a drawdown that's recoverable, so that we can also have some return attached to it, okay? So let's talk about investing for a second. I want to walk you through some of the ways that we think about asset allocation and focus investing, how we think about fundamental and technical analysis, how we think about active and passive investing, strategic and tactical decisions, and give you some examples. So Again, we have an adaptive and dynamic process. So we're going to evaluate the economic conditions. We're going to evaluate your situation, and we're going to blend those together. We're going to determine the appropriate asset allocation strategies to use. We'll use Monte Carlo and back testing to help us hone that in. We will develop some type of plan for you, either a written investment policy statement or a summary or a financial plan that will help put all this in writing for you. Then, of course, we're going to measure, evaluate, and communicate. And finally, we monitor both the market dynamically. That's our job. And then your job is to dynamically monitor your situation and inform us if there's new life events or things that have changed in your life that will require us to reposition the portfolio to give you a better chance or probability of achieving your goals. So, when we talk about investing, we always like to talk about the two sides of the coin, right? There's only two sides. There's risk on and there's risk off. So on heads, let's say there's risk on, tails, there's risk off. We also like to use these two coins because on the red money, right, you have the bull, and a bull is you're in the market and you're trying to make money, but when you're riding a bull, there comes risk, right? So you have to take risk when you're seeking that return. When you're in a risk-off environment, that's usually when a bear market started, right? There's cyclical bear markets, there's structural bear markets, there are bear markets that are started by events. And so in a bear market, we want to turn to that green money, right? We want to turn to that protection. And so let me go back a couple slides and just talk to you about that perfect investment again. So when you think about that perfect investment, there's portfolios that are built for the bear markets, and there's portfolios built for the bull markets. Now, unfortunately, we can't predict, with perfect hindsight or forethought or foresight, what the markets are going to do. So that's why we like to have a balanced portfolio where we're deploying some strategies that are falling into the group A that provide liquidity with some protection, while at the same time deploying some of your assets into Group B, which provides you the protection with some gains. And then the final allocation in the portfolio construction process is to put you into the red money or the market where you have potential for gains with some liquidity. So by having a balance of that perfect investment, because there isn't one perfect investment, but there is a way to blend these less than perfect investments together to give you a portfolio that has a high probability of achieving your goal. So it's always good to come back and remember that we have risk on and risk off, and that we have to find a way to balance those two. So here we go, risk on and risk off. So for an example, asset allocation is a great approach. You've heard of it before. It was made famous by Harry Markowitz in the 1950s. It's called modern portfolio theory. It's your pie chart theory, right? Asset allocation. And it's a risk-off strategy. The returns are always going to be average, okay, because it's allocating across many allocations or many asset classes. It's putting more than one egg in one basket, and it provides diversification. On the other side of the coin, right, so we have tails on one and heads on the other. And the tail here is the tail of that bear, and the head is the head of the bull. And we have focus investing. And focus investing was made famous by Warren Buffett. And what Buffett tried to do was he was seeking to accumulate wealth. And by doing that, he knew he needed to redefine risk. He needed to take risk and think about it differently. So he didn't think about risk as the ups and downs of the market and the price movement, but he was looking for that margin of safety. He was looking for the permanent loss of capital, okay? And so under focused investing, we're seeking a higher return. It's going to have higher returns and higher lows. It's accepting risk to maximize return, where asset allocation was accepting return with its primary objective of avoiding risk. Okay, and then of course focus investing may provide diversification. So really what we have to do, the challenge, is to find the right mix of the bull and the bear for you, right? How much red and how much green money do you want? And so, for example, somebody might be 50-50. It might be that I'm not sure, I think I'll be 50% risk off and 50% risk on. That's great, okay? Another person might want to be 70% risk on and 30% risk off. Okay, that's fine too. They both are correct at the same time because it's really up to the individual investor to determine how much risk on and how much risk off is appropriate for them. So how do we help you do that? Well, we can help you do that by looking again at two sides of the coin. All right, everything comes down to two sides of the coin, heads and tails. So on one side of the coin, we have your ability to take risk, and the other side of the coin, we have your willingness to take risk. And so most people are probably familiar with this section over here, this willingness to take risk, and this is represented by some type of risk score, Riskalyze, On Point, a risk questionnaire, right? And this is where you score a 40, you answered some questions, and you score a 40. So what most advisors would do is they'd put you into a portfolio, a pie chart that looked like a 40. Maybe it was a moderately conservative portfolio. Well, the problem with just looking at half an argument or half of the side of the coin is that you forgot to look at the ability. So here's the scenario. Based on your financial plan, you needed 9.35% to make your life come true. So we look at where you're at today, we look at your assets, we look at your life expectancy, and we look at all the cash flow in between. Taxes, fees, inflation, retirement money, weddings, new cars, new roofs, okay? We model out your life. And when we model out your life, it gives us a required rate of return. And that's what you need to earn to make your life come true. So in this case, this investor is needing a 9.35% return. That's the ability. And they're only willing to take a 40. And so what's going to happen is they're going to fail, right? One, if the advisor puts him into a 40 portfolio, a nice asset allocation pie chart, moderately conservative portfolio, let's say is going to do 4%. Okay, so they're going to get 4% when they need 9%. And that is a guaranteed way to fail. But nobody knows it. The advisor didn't know it, and the client didn't know it. And that's because they're only looking at half the argument. Okay, or half the evidence. We like to try to look at the preponderance of the evidence and all the math and science that we can get our hands on to make sure that we have a balance between your ability and willingness to take risk. Okay, so if that happens, what do? Well, we have to have client education. You're going to have to push off your work optional lifestyle. You're going to have to save more, spend less, and the one that nobody chooses is to die sooner. Okay, now there's one other thing that we can do. We can deploy institutional investment management processes to give you a better built portfolio. So that's another way to close the gap between your ability and willingness to take risk, where you can short the market, we can go to cash. Okay, as you're going to learn, we can be tactical in the way we approach managing money. There's times, because we are adaptive, that we can be more fundamental or more technical. And I'm going to go through that in just the next few slides. So again, it's very important to understand your ability and your willingness to take risk. So when we think about risk, it's also not just a point in time. Okay, it's kind of a continuum, so that you could be 100% risk off, you could be 100% risk on, or you could be anywhere in the middle, anywhere in between. Okay, so let's look at an example. So for my example, I'm just going to use 50% of risk off and 50% risk on. And so let's say that the green money, the risk off money, can earn 4%, and it can never go down. Okay, it's locked into an annuity, or it's locked into something that's guaranteed. So you're only going to get 4 on the upside, but you can never go down. And then the other 50% of the money is going to go into the bull, right, into the red money. And maybe that does 7%, like the market average over a long period of time. Now, of course, none of these returns are guaranteed. I'm using these for examples, okay? So you put 50% of your money that can do 7, 50% that can go up 4. So on the upside, your portfolio can do 5.5%, right? 50% of 4 is 2. 50% of 7 is 3.5. You add those together for a total portfolio return of expected return, again, not guaranteed, but a total expected portfolio return of 5.5%. Now, what if the market goes down? Well, if the market goes down, 50% of your money did not go down, therefore it's 0, and 50% of your money went down 20%. Now, can it go down more than 20? Of course, this is just an example. But in this case, if it goes down 20, 50% that went down 20 is only 10, and therefore you can see here in the bottom right-hand side of the slide that your total expected portfolio return would be negative 10%. So this is an example of a 50% risk on in the bull and 50% risk off on that green bear, okay? And this is how you can determine what amount of risk is right for you by blending a risk on and risk off strategy. Okay, fundamental and technical analysis. We deploy both in managing your money. So we believe in fundamentals and we believe in technicals. Now the cool thing is that we're adaptive. So sometimes we are 100% fundamental, sometimes we're 100% tactical, and sometimes we're 30% tactical and 70% fundamental. We change our research and we redeploy our tools based on what's going on in the market, right? We don't just anchor and say, well, this used to work and I hope it works again. That'd be crazy. We're going to keep our eyes wide open, use all of our tools and resources, and then deploy the right math and science at the right time. Now, can we be wrong? Of course we can. But what we're trying to do is show you our institutional process and how we think about things. So fundamentals tell you what to buy. We're looking at company management. This is where we're looking at all the fundamentals. We're reading the financial statements, okay? Technicals are telling us when to buy. We're looking at the charts and graphs and doing more of the work on the relative strength and momentum side, okay? Now, you need to know who you are as an investor, right? We believe in both, but I'll tell you a story about, there's only two people that can, in the market. There's a fundamentalist and there's a technician. So the fundamental analyst identifies a stock that's worth $100, but it's trading at 50. So he buys it. That buying power then creates volume and momentum, and the technical trader picks that up. They see the stocks in play, so they jump on and buy. Well, the more demand, right? Supply and demand, so there's more demand for that stock, and it hits its $100 price target. Well, the fundamentalist goes, well, I hit my price target, it's time to sell, so they sell, putting downward pressure on the stock. The technician picks that up, so they jump on and they start selling, and therefore we go back down to 50, and then we do it over and over again. So there's really only two market participants out there. It's the fundamentalist and the technician. And the common goal is they're both trying to determine which way prices are going, okay, or likely to go. They're just coming at it from different directions. The fundamentalist is coming at it by studying the cause, and they believe that known fundamentals lead price. And the technical analyst is studying the effect and believes that the price leads the known fundamentals, okay? So they're coming at it from opposite directions, but they're trying to go in the same direction. Active versus passive. Well, sometimes, again, because we have an adaptive institutional process, sometimes we're 100% passive, sometimes we're 100% active, right? Sometimes we're 50-50. Again, what we're trying to do is gauge the market and then apply the right tool for the job at the right time. So active management tries to exceed the benchmark, right? Provides what we call alpha, return over a benchmark. It may apply fundamental or technical analysis. It can be used with asset allocation or focus investing. It assumes the markets are not efficient. It's a dynamic management, and it's rules-based technical and quantitative procedures. A passive investor is attempting just to match the performance of an index, which is called beta. It minimizes fees and trading costs, and it assumes the markets are efficient. Okay, and so in 2013, we had two Nobel Prize winners that one of them won for active and one of them won for passive investment. So Robert Shiller won for active management and Eugene Fama won for the passive indexing. So they're wonderful professors, very bright men. Who's right? They're both right. Who's wrong? They're both wrong. What you need to do is find the truth in the middle and apply a little bit of active at the right time, a little bit of passive at the right time, and be adaptive in the way you approach your market. So it's more of an adaptive market hypothesis. Okay, this is a fun one, tax managed versus actively managed. So a lot of our investors say, well, we're very concerned about taxes, but at the same time, in our taxable accounts, we want to be very active and tactical. Well, if we're actively trading and actively managing in a taxable account, it's on the other side of the coin of being tax efficient. You can't be active and tax efficient at the same time. So we can be very tax efficient, okay? Or we can be very active and tactical, but it's hard to be on both sides of the coin at the same time. We can be both in a deferred account where there's no current taxation. Then we can be active at the same time and be very tax efficient. But at some time when you come out of that IRA deferred account, you're gonna be paying probably higher taxes at the top marginal brackets. So tax managed provides lower turnover. Security selection and account location is important. It's more of a passive management, longer holding periods, higher portfolio drift because we don't rebalance as quickly, and it's focusing more on long-term capital gains at lower rates. Active management is higher turnover. Security and account location is very important. It's much more dynamic in active management. Shorter holding periods, lower portfolio drift, because we're rebalancing more frequently, and there's short-term capital gains and higher tax brackets. So again, those are the differences on the two sides of the coin of tax managed versus a more tax efficient and a less tax efficient strategy. Strategic versus tactical decisions. Again, here the strategic has to do with you, the investor, and more of your time horizon, your risk profile, your required rate of return, your taxes, your inflation, and that's usually wrapped together in an investment policy statement and or a financial plan. And tactical strategies are typically that we think we know something special. It counts for trends in the market, stocks over bonds, international stocks over U.S. stocks. So tactical is usually a short-term remedy, where strategic planning is usually a long-term strategy, and they need to go together. So sometimes we're more strategic, sometimes we're more tactical. Again, as you're picking up today, we're an adaptive institutional fiduciary money manager, and we're going to weigh the evidence on all of these sides of the coin to get you the right balance in managing your money for your objective of accumulation, distribution/spending, right, and or capital preservation. Now, would it be nice if we could tell you what the market was going to do? I mean, the market can only do three things, right? It can go up, it can go down, or it can go sideways. And so what we can do is we monitor the market and the dynamics to see if we're in a mean reversion market or if we're in a trending market. And so what you need to take away from this is that if we're in a trending market, we need to use the right tool for the job, more your moving averages, okay? If we're in a mean reversion market, we need to use oscillators. Now, moving averages and oscillators probably don't mean much to you, and that's okay. All we're saying here is that if we're trending, we need to use trending tools. If the market's mean reverting, we need to use mean reverting tools. And sometimes the market's in a white noise process where we just don't know what it's doing, and that obviously calls for more caution. But if we can understand and make money out of two of those three directions, we can make money if the market's going up or down. Okay, we can make money if the market's mean reverting or trending. Then we've got the odds on our side, right? 2/3 of the time, we're going to be able to hopefully have a better trade or making the right decision in which way the market's moving. Now, we talked about asset allocation. Most of you are probably familiar with asset allocation. It's your pie chart theory under modern portfolio theory. And this is where you're going to have some stocks and some bonds and some cash, and you're going to have some large cap and small cap and government and mortgage. You're going to have a globally diversified portfolio. We love this theory. It's worked very well, except for the last 10 years when the market's been on a risk-on mode, and the name of the game in town has been U.S. equity. The asset allocation hasn't performed as well as it has over the last 20 years or full market cycles. So when the market's risk on, we need to be on the right side of the coin. We need to take more equity exposure. When the market turns into a structural bear market, okay, we need to go to risk off assets and put on more asset allocation. So again, asset allocation isn't good or bad. It just needs to be used in the right proportion at the right time. And again, we monitor this and then try to adaptively change that to match the risk profile of the client. So some clients want to be 100% in equity. That's great. We can support that. Some people want to be 100% risk off in bonds. Some people want to be 100% risk off in asset allocation or less risk in allocation. And some people want to be in a mix of both. So it's important for us to understand when things have changed in your life so we can rebalance your portfolios. But just keep in mind that we're always thinking about risk on and risk off. Risk off isn't going to make you a lot of money, but it's going to protect your money. And risk on, you're going to have an opportunity to make more money because you're taking or being more accepting of the risk that you're taking in trying to achieve that objective of accumulation. Asset allocation also sits on an efficient frontier. So on this axis over here, you see the return axis is on the y-axis. On the x-axis is risk. And so the ideal portfolio in this example would be on this green line right here, this green bullet. Why? Because for the same level of risk, okay, this vertical line, you're getting a lot more return than you are if you were on this gray bulleted portfolio, where you're taking the same risk but getting a lot less return. So as market conditions change, we're going to change and adapt and maintain efficiency and try to keep your portfolio positioned on this green line as opposed to the off the line in an unideal portfolio. So that's asset allocation, the efficient frontier. And one of the things that we do, and we'll show you in a few minutes, excuse me, is we have portfolios that are built for this axis here for return, and we have portfolios built for more risk management, and we'll show you those in a few minutes. So when I come back, when I talk about the tugboats and the sailboat or speedboats, I'm going to refer to this efficient frontier graph again. With asset allocation, returns are always going to be average. Again, if you're investing in a little bit of everything, you're getting a little bit of everything. You're getting what worked, you're getting what didn't work, so you're going to get a mathematical average. And so here we see these green boxes represent a 60% equity, 40% fixed income portfolio. And you'll notice that the line goes through it, right? And it's always in the middle. The green box was never the highest, it was never the lowest. It's always an average of the asset classes that make up that portfolio. So again, asset allocation isn't broken. It's just when there's only been a couple asset classes working, mainly U.S. equity, if you're not predominantly in U.S. equity, you're not going to get the returns that you might be seeking. But again, you might not be willing to take the risk that goes along with it. So again, asset allocation is not broken. It's just meant to give you an average return. It's more of a risk-off strategy. And if the market returns back into a long-term bear market, the allocation will start to work a lot better than when we are in a risk-on mode of the market. Okay. With focused investing, we're not trying to buy all of these asset classes. We're just trying to buy the top 3, 4, 5, okay, and avoid the bottom. Or we're trying to buy the top 3 to 5 and maybe short the bottom, okay? So we're being a little more tactical. We're just not allocating across all the asset classes, but we're trying to focus on just a couple that are working. So it's less diversified, right? It's less allocation, more focused, therefore more potential return. So what we're trying to do with our active and tactical management is we're never trying to time the market. We're not market timers. So you notice that we're not trying to buy at the bottom and sell at the top. And it's not that we're not trying to do that. It's just impossible to predict the future. We can't be market timers, right? But what we can do is we can look for signs of strength. Okay, so here we've seen some momentum. So we buy, we ride the majority up. Okay, and then when we start to see signs of weakness, we can sell that investment. Again, we're trying to get the majority of the up, lop off the majority of the downside, ride those bulls, tame those bears, and be reasonable in our risk-adjusted returns. Now, we don't just do that with one investment. We can blend the trend, right? We can use a team of indicators and a team of asset classes so that we can pass the baton. If we're going from momentum to value, we'll stay in momentum and we'll shift to value, or value to momentum, or what have you. So here again, we'll buy investment A on strength. When it starts to run out of steam, we'll sell A and pass the baton to B, and then we'll ride B up until it changes its momentum. Okay, so we can do it with a single asset. We can do it with a portfolio of asset, but we're trying to be dynamic and tactical and get the majority of the up, lop off the majority of the down, and provide reasonable risk-adjusted returns. Okay, let me take a drink of water real quick, and then we're going to go into some portfolio solutions. Portfolio solutions. So our value proposition of our active and tactical management is that we build robust and prudent, purposeful portfolios by blending a lot of the bulls and bears that we just showed you. So we follow quantitative methods, fundamental analysis, dynamic portfolio theory. Okay, so again, we're going to use rules-based technical analysis, multi-factor models and regression, charts and price and volume. We're going to do bottom-up research on the fundamentals and free cash flow of the company. We're going to use dynamic modern portfolio theory and advanced Black-Litterman modeling to apply views to our return and risk profiles. And then we're going to use a lot of other fancy math that, again, we can't predict the future, but we're trying to build better portfolios with new updated tools, right? New updated adaptive and institutional tools that aren't available to retail investors and that weren't available in prior years because of computer power. So we're using technology to our advantage in deploying our institutional portfolio processes. So what do we manage? It's always evolving, okay? But we have an individual bond portfolio. Again, we prefer individual bonds over bond ETFs and mutual funds. We can control risk better. We have 3 different types of asset allocation models that range from conservative to aggressive, okay? So that ends up to be 15 different types of asset allocation models. We have 2 individual focused stock portfolios. We have a real estate portfolio, a couple different types of real estate portfolios, a couple private hedge funds, okay? And then of course we make structured notes, which is a wonderful risk management tool. And we custom build those again because of our institutional capabilities. So our stock portfolios, there we go. Let's see here. Our stock portfolios are focused, our allocations, we have both focused and allocations. And then for our bonds, we focus and hold typically 5 to 20 bonds. Okay. We don't just have to deploy one strategy. The way I designed our fleet of ships or boats or our portfolios was to be used together. So when you go play golf, you don't just go with one club in your bag. You want to go with 13 clubs in your bag. You want to have a driver. You want to have a 7-iron. You want to have a putter, right? You want to have an 8. You want a fairway wood. You want a sand wedge. So you want a variety of tools or clubs in your bag, so no matter what the shot you need to make, you have the right club in your bag. Well, the same with our portfolios. No matter what portfolio objective you have, we want to have the right portfolio for you, and then mix those portfolios as appropriate. So we can have a core portfolio, and then add a little more risk to it by adding stocks. We could have a core portfolio and de-risk the portfolio by adding more bonds, okay? So what we're doing is we're just gonna mix and match our strategies to provide a balance of risk on and risk off assets based on your unique circumstance, your unique circumstances and the conditions of the market, okay? So we can blend our strategies. The tugboats, okay, they're built for risk. You'll notice here that we pin risks down here. So these are for your loss-averse investor. These are people that are more concerned about losing money than making money. So you're going to have 5 nice portfolios down here that are risk management, dynamic volatility managed portfolios. The speedboat, okay, those are meant more for a traditional risk-averse investor. We're going to pin the portfolio to the y-axis, the return axis of the efficient frontier. Okay. And then we have our sailboats. Now you notice our sailboats do not anchor, pardon the pun, to return or risk. They're trying to go to wherever the wind is, aka the return. So they're not built on modern portfolio theory. Okay, they're 100% tactical with using ETFs. So the tugboat and the speedboat are strategically built with tactical overlays, and the sailboat is tactically built with a strategic overlay. Okay, so now you're starting to see how we blend some of these things. So when we go back and look at our battles between active and passive and fundamental and strategic and tactical and tax managed, you see each side of the coin, the bull and the bear. You're starting to see that we're going to deploy all of these unique management strategies into the portfolios that we build. And so here you can see a summation of our tugboats and speedboats are full allocation models. our sailboat is really kind of in the middle, right? We move our sailboat over here into the middle because it is part allocation, part focused, okay? And then our stock strategies are focused and our bond strategies focused. So we can have risk on assets, we can have risk off assets, we can have focused portfolios, or we can have allocated portfolios, okay? So we're very adaptive again and able to provide that institutional process to managing your money. As an example, just to give you a good flavor for how we build things, I'm just going to run you through a few of the portfolios. I'm going to run you through the sailboats, okay? We call these focused tactical allocation portfolios. They're rules-based asset allocation. They're using low-cost or no-charge ETFs, okay? And they're very dynamic. So here what we do is first thing we do is we select a global universe. So we're watching about 200 asset classes at any given time. We determine if the market is bull or bear. Right, so we thumbs up or thumbs down in the market, then we build your portfolios and we repeat and rinse. So we're going to be looking at market capitalization, small, mid, and large. We're going to be looking at equal weighted market, small, mid, and large. We're going to look at style, defined by value, growth, and blend. We're going to look at global sectors, and we're going to look at currency or countries. So we could be in large cap companies in Japan, we could be in small cap European banks, we could be in the yen, we could be in the S&P 500. We're just going to rotate to wherever the return is out of that global universe. Okay? This chart is a little hard to understand, but what we're trying to do here is we're just trying to get a thumbs up or a thumbs down on the market. So are we on the left or right side of that coin? Are we on the green side or the red side of the coin? Are we bull or bear? Okay, risk on, risk off. And once we know if we're risk on and risk off, then we'll know how to deploy the portfolios. So in determining if we're risk on or risk off, we're going to look at multiple time periods, short, mid, and long. We're going to look at multiple signals, factors, and methods and weighting. So we don't just look at any one chart or graph. We're going to look at the preponderance of the evidence, both from the fundamental side and from the technical side. Again, we're blending fundamentals and technicals to try to give us a better understanding of what the market's doing. So now that we understand if we're thumbs up or thumb down, we can build a portfolio. So on the sailboats, each sailboat has an upper deck and a lower deck. So each one has part equity and part fixed income. In this example, this is 70% equity and 30% fixed income. In the equity portion of the boat, there's three different compartments. There's a long only. Okay, what that means, if we're bullish on the market, we're in the top three equities out of our universe. If we're thumbs down, if we're bearish, we are in cash. The second compartment of our equity strategy is a broad global sector rotation. It's always invested, okay, but it does have a safety valve. So if the world equity markets are melting down, it can rotate to cash and or fixed income. The third compartment of our equity sailboat is long or short. If we're thumbs up, we're in the same 3 to 5 equities that we were in the long only out of our universe. And if we're thumbs down, we're going to short the market. That means take advantage of the market going down by buying an ETF that gives you the opposite return of the market. Okay, so if the market's going down, this fund would be going up. So we will get you the inverse of the market. Okay, so it's shorting the market. So that's now that we know that if we're going to be long or short, now we have to select the investments. So what we're going to do here is we always want to measure 3 times, cut once. So we're going to use multiple ranking methodologies, multi-factor and linear processes. We'll even use some quadratic processes. But for example, here there's 3 ways that we might pick a security. Option 1, 2, and 3. And we're looking for the top 2. So starting from the right, you got number 1, number 2, number 3, number 4, number 5. Okay. So let's look at the first method. The first method, A was the winner, then B, then C, then D, then E. Okay. The next methodology produced D, A, E, C, and B. And then the third measurement was A, C, B, D, and E. So in this case, A made it into the portfolio. It made it into the portfolio because it was in one of the top 2 spots out of all 3 measurement processes. That gives me stronger conviction that I'm making the right choice by putting A into the portfolio. Now let's think about if I would have picked B under option 1. If I would have picked B under option 1, it was in second place. Wow, that's pretty good. Okay, I'd be feeling good about that. But by looking at the preponderance of the evidence and following an institutional process, right, measuring 3 times and cutting once, I noticed that B was the worst selection under option 2, and it was in 3rd place under option 3. So with that evidence, I'm not as convicted that B belonged in the portfolio. So now you can see that by only measuring once or looking at half the side of the coin or half the argument or half the evidence, that we might not be making the best decision when compared to using both sides of the coin, looking at all the evidence and using more than one methodology or more than one process, okay? So that is how we would then rank those 3 investments. A would have made it into the portfolio. Let's talk about our stock selection strategies real quick. So everything that we do, again, is an institutional process. So we have screening processes, research, buy, hold, sell decisions, reports, monitoring. So again, we're following an institutional process to help us provide better and more consistent results. And when we deploy our research, remember that we're adaptive and so that we're not always doing the same thing at the same time. In this example, we are spending 15% of our time on economic analysis, 35% on quantitative processes, and 50% on qualitative processes. Okay? Now, at a different point in the business cycle, we might be 1/3 of our time on economics, 1/3 on quantitative, 1/3 on qualitative. At another point in the market cycle, we might be 100% qualitative, 100% quantitative, 100% economics. Okay? So all we're doing is we're adapting. Now, do we know what the future holds? No. But what we're trying to do is use all of the evidence, use everything that we have at our disposal to make a better decision. Okay? And again, the most important thing here is that it's an adaptive institutional process. We just don't anchor to something and hope and pray that that works. We do pray a lot. Okay? Pray for us. We are managing your money. Okay? But we don't just we just don't put that in the hope category. We're going to use all the evidence in math and science that we have to better position the portfolios. Very adaptive. Okay, the focus growth strategy. So I put the red bull up here because this is a risk-on strategy. This is a strategy that's all equity and it's trying to accumulate wealth. So the goal here is to be an adaptive stock portfolio constructed for all market conditions, okay, and return and perform like the general U.S. equity markets. It holds 5 to 20 stocks, and it wants to perform like the S&P 500 over full market indexes. On any given one day or year or quarter, they might be higher or lower. What we're really trying to look for here is that long-term performance. So we have a dynamic way of building this. Again, it's not just one way. We measure 3 times. So we have 3 filters that we dynamically monitor, all right, and then we select and weight the leaders. So the first way that a stock can get into the portfolio is through a sector rotation or a technical filter. The second way a security can get into the portfolio is through the fundamental filter. So there we go. We have fundamental and technical, right? So both sides of the coin. And then the third method is a quality relative valuation perspective, which is a blend of the technical factors and a blend of the fundamental factors. So it's blending both the first and second filter. Let me run through those. The first filter is all technical. We start with 6,000 stocks. We get those down to 40 sectors. 40 sectors, we're looking for the 3 to 5 sectors that are showing the most promise. And then we look for the 10 stocks that look to be trending best within those sectors. So on the right-hand side of the slide, you have a toolbox. Now, these are just a few of the tools that we have. We can look at relative strength, momentum, moving averages, volume, supply and demand, oscillators, okay? So we'll look at a large radar screen and we'll figure out what's working, and then we'll deploy it over here on the left-hand side to go through our factor filter, okay? So here we're using relative strength, momentum, and valuation to make our final selection of our 10 stocks. So we get 10 stocks, we set them aside. We go to our second filter. Our second filter starts with a distinctly different universe. Instead of 6,000 stocks, we're starting with 3,000 stocks represented by the Russell 3000, which represents small, mid, and large companies, predominantly U.S., but not 100%. Now we're pulling out of our toolbox fundamental factors, okay? So now we're looking for good management, earnings, cash flow, discount rates. We're more looking for a quality company with a good manager that's trading at the right price, right? A lot of the stuff that Warren Buffett looked at. So we get our 3,000 stocks filtered down, and we pick the top 1 to 10, and we stick them aside. The third filter is the S&P 500. We get it down to 75 high-quality stocks with a quality screen, so you'd be happy owning any or all of those 75. But then we overlay the filters from step 1 and step 2, so now we've got 10 stocks that were out of 500 down to 75 down to 10 by following that institutional process and blending both fundamental and technical indicators, and you have a great filter, okay? So what does that leave us with? That leaves us with potentially 30 stocks. We could have 10 from each one of these filters. Now, what's very interesting about this strategy is that by process, we could be 100% in cash. So if nothing's coming through these filters, the portfolio will automatically go to cash. Another way that we can go to cash is by a tactical overlay. And from all the technical work that we're doing, right, we will determine if we need to overwrite the process and add cash that way as well. So 2 ways to get to cash, so it's very tactical, through process or through a tactical overlay. Now, the final selection of those 30 stocks is going to be based on an optimization process where we are trying to minimize the active risk against the benchmark, hold 5 to 20 stocks, and have a 1-year portfolio return in excess of the benchmark. So there's your pink unicorn. We're trying to have higher return, lower risk than the benchmark, right? And that's what every investor's trying to do. So we're going to hold 5 to 20 quality stocks with a 1-year return objective in excess of the market while maintaining lower risk than the market. We rebalance that quarterly, and intra-quarter we monitor it to see if we need to put something else in the portfolio or remove something from the portfolio. So again, we don't just set it and forget it for 3 months. We rebalance it quarterly, but we look at it daily. Okay, the focused dividend is another stock strategy. The goal here is to provide you an adaptive portfolio for both growth and income. We're going to hold 5 to 20 stocks. We're going to have a 1-year return objective higher than the market, a dividend between 4 and 6, a beta, which is a measurement of market risk. We want that less than 1. A beta of 1 means you're taking exactly the same amount of risk as the market. So we want something, again, risk adjusted, and we want that higher return and lower risk. So we start off here with 5 different dividend benchmarks. And we monitor those to see which one of these 5 is working. Then we weight those 5, okay, and make a custom benchmark each quarter. So dividends work quite different than the S&P 500 because of the life cycle of a company, how they go from a small cap company to a mid cap company to a large cap company, and how they sustain their competitive advantage. And so we need to look at rising dividend achievers, a dividend appreciation, high yield, dividend leaders in the Dow Jones global sectors. So we look at those 5 indexes, we determine which one is performing best over the last quarter, and then we weight that. In this example, we're using 40% rising dividend, 40% dividend leaders, and 20% dividend appreciation. Now we can go to our selection universe. So now we'll take 3,000 stocks and we'll weight them based on the index that we created, and we'll come up with a short list. So now that we have a short list, we can optimize. What are we trying to optimize? We're trying to give you that minimizing risk against the benchmark, having a higher 1-year return than the benchmark, having a dividend yield of 4 to 6, and maintaining a beta of 0.75 to 1. Okay, and there you're going to have 5 to 20 quality stocks. So that's the process for the dividend portfolio. For the focused bond portfolio, this is an adaptive global go-anywhere bond portfolio using individual bonds. It holds 5 to 20 bonds at any given time, and it's using credit analysis. It's looking at duration. It's looking at market yields and the shape of the yield curve. So it's using a lot more fundamental data in determining how we're going to position the portfolio, but its objective is to outperform the general U.S. bond market. Again, it's very adaptive, okay? And when we optimize it, we're looking again to do what? Optimize return, minimize risk. So when we talk about risk in bonds, we usually call that duration. So it's just a different word for risk when we talk about bonds. So again, we want to minimize duration, maximize that yield to maturity, maintain a high quality bond. So it's triple B or better. We want investment grade or better bonds. We're not trying to chase returns by buying junk. Okay. So again, a pink unicorn, we're looking for that high risk adjusted return proposition. Okay. Well, I know that was fast, but I really appreciate your time, and we look forward to having further conversations with you or diving down to any of our portfolios further. So please just reach out to us, and we'll be happy to sit down, walk you through the presentation again, get you further information, or help make sure that your portfolio is positioned where it needs to be for the current market conditions and for where you currently are in your life cycle. Whether you're in a work optional lifestyle right now, or you're trying to get to a work optional lifestyle, just let us know what your goals and objectives are, and we can rebalance the portfolio as necessary. So again, thank you so very much for taking the time to watch this video today. My name is Joe Maas, and we thank you again for your trust and watching this video today. Thank you very much.